Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome to the KE Report Weekend Show. Corey and Shad here, your host for this weekend edition. Also your host on our website, kereport.com, and podcasts. Just search the KE Report in your podcast player to listen to all our daily editorials of market commentary throughout the week, as well as company updates that we posted throughout the week. On this weekend show, we're going to be sticking to resources and commodities in the first half of the show. We're going to be focusing on the metals sector. Back half of the show, time to move over to energy in the oil and gas sector, all tying it into really how to invest heading into next year, some of the key themes, and maybe even a couple companies sprinkled in. We're kicking off the show with Joe Mazumdar, editor of Exploration Insights. Joe, it's pretty much the end of the year, so let's give a quick little review of what happened in the metals sector, especially precious metals. Overall, it was a good year for gold and silver especially. A lot of other metals were mixed, but again, at worst, maybe sideways movement in a lot of these metals. Choppy, that's for sure. Gold up about 30% this year. Silver up about 40% this year. GDX up about 30%. GDXJ up over 35%. SIL is up over 40% this year. So again, overall, Joe, it's a pretty good year for precious metals. We're still hearing a lot of CEOs complaining about the market, though. So, Joe, from your standpoint, the newsletter writer standpoint, and the investor standpoint, what's your takeaway from 2024?
Well, if we stick to precious metals as a theme, obviously, as you said, gold has done well. And probably earlier in the year, as we mentioned off air, it was being supported by central bank purchases when interest rates were looking to be flat to, real rates were probably going up at that point. And then when those central bank purchases, specifically from the Chinese, ended in the summer, then the realization or the expectation that there might be a significant cut in interest rates in September brought ETF buying back in, specifically US. And what's positive about US buying gold equity ETFs is money that seeps into equity ETFs. So that when they're buying the gold ETFs, some of that funds will sink into equity ETFs, which supported the GDX, GDXJ going into September. And then we had the geopolitical crisis. And so that was also an underpinning for the gold price. But then when the interest right now with the incoming administration, there's an idea that maybe all these wars are going to be over. So maybe some of that geopolitical crisis or risk comes back off. Although now we just had the Syria incident just recently. But now what we're having is the Chinese coming and buying again back in November. It looks like they're back in the market. So for me, I guess when you look at this year, a lot of fortuitous multiple sources of buying for gold that kept it going up, kept that balloon in the air, basically. Either the breath was being blown by the Chinese buying gold from the central banks, or it was gold ETF buying by the US institutions in anticipation of lower interest rates, so low real rates. And then geopolitical crisis, that would get people into buying physical gold. But also, I would say, another thing would have been, buying by Chinese retail as well, because as their economy has been sort of floundering for them, we have a lot more demand from them in terms of the hold of value. So again, multiple sources of value sort of support for gold, which has been positive and led to, it's outperformed lift this year. And then silver, leverage, showing its leverage. And I think some of that as well is driven by the supply side, because, silver is much more a marginal cost industry than gold, but it's also got the issue with byproducts. But what we're seeing is because of what's happening in Mexico, which is one of the biggest producers of silver, is that people are worried that there might not be, enough silver dominant assets out there that might be developed if Mexico is not very pro mining, which, under the new president will just continue the sort of anti-mining legislations of the previous president, which was AMLO. So yeah, that's basically my summary for gold and silver. And as we said, base metals more mixed. I'm still big into copper, but because of the more moderate Chinese economy, that those markets haven't been particularly buoyant. But I think on the supply side, as we look at M&A and that, industry knows the issues with copper and the lack of an incentive price to develop, which will just make a bigger springboard for copper going forward. So I'm still bullish on copper despite the Chinese weakness. I know China is bringing out some stimulus packages, which before the end of the year might help. But the other overhang we have is this potential imposition of tariffs. What's that going to do to the global economy? What's that going to do to Chinese consumption of commodities? So yeah, a lot to take in, at the end of the year.
Well, Joe, I think that's a great synopsis of the metals, gold, silver, and copper. Let's dive into some of the gold and silver equities, though. It was kind of a mixed year in the equities. There was definitely companies that did well, that blasted to new highs. There were some companies that at least had an upward trend, but maybe on par or even lower than what we saw in the metals prices. And there were still a lot of juniors that really didn't have as much action. So it was a tale of the haves and the have-nots. What are your main takeaways as far as the different areas of the gold and silver equities?
Well, I find that the ones that have done very well have been, underlying outstanding assets and management, like Alamos has done very well. And then also Lundin, they have a high margin asset in Ecuador. That's done very well. But other companies that have not done so well have had issues with their underlying assets, with the costs going up or geopolitical issues, like in West Africa. So those can be problematic, as we've seen, with Mali putting out an arrest warrant for Mark Bristow and that. So people are now rewarding highly assets that are in geopolitically benign jurisdictions. And if you add on high margin assets, that's where the weight of the investors are tending to lean.
Yeah, that's been the trend in M&A too, is higher margin assets, and even those that are built. Joe, does that change in this environment? Does money start to filter down into more of these exploration plays, or are we going to continue to be in this environment where companies see it being cheaper, more effective to buy ounces in the ground rather than actually discover them?
Well, yeah, exploration, grassroots exploration in most commodities has been going down. And, part of the reason is because the juniors that try to do it are not getting funded as much. So that's been an issue in terms of grassroots. But if you are a intermediate or a major producer, you're trying to avoid the issues with permitting, and you're trying to avoid the issues with capital escalation by buying production and not caring if you have to pay a premium for it.
Well, Joe, when you look at some of the M&A that we've seen go on, we have seen a lot of production assets scooped up to be bolt-on operations, maybe help a company's jurisdictional profile and or just their overall cost basis. But we did see a lot, we saw a lot of M&A this year. We did see a lot of companies combine into mergers where there were development companies merging with development companies. And we did see some high-profile takeovers like Goldfields going after Osisko Mining or Calibre going after Marathon, Filo getting scooped up by BHP and London Mining. So do we think we see more of that in 2025? Some of these developers getting picked off?
Well, that's my hope, and that's a hope of a lot of the developers that are sitting there trying to find funding for their project and hoping to get picked out. But, some of that issue has been like with B2Gold buying Sabina, the Goose Lake project. That capital has kept increasing and the costs have kept going up. So even though buying the company to acquire the asset looks accretive, The problem is actually when you get into building it, how accretive is that? And so that's, I think, some people will still be wary of those kind of projects because they'll want to know the capital number, how good it is. So the study has to be good and they have to believe it. And so somebody who puts out a PA with a really nice number with a 40% IRR, that's going to get looked at a lot. Even though retail might think, well, this is a great project, somebody from outside might say those numbers are all wrong, and it's not going to look like that. So they just sit on their hands with projects like that. So I think that, yeah, the development projects or advanced exploration projects like we saw Reunion Gold's Oko West, a high quality deposit, open pittable, Guyana, that got bought by G Mining. So those kind of assets, I think will be the ones that get acquired in terms of development assets. But then as we look geopolitically, are we going to see M&A in West Africa? I don't know. Because I think that a lot of these guys overexposed to West Africa might be doing M&A, but they might not be doing it in West Africa.
Joe, I find this to be one of the most important topics for the sector, for the underlying precious metals equities, and not just from this last year, but over the last number of years where there are so many defined resources out there all around the world, all with different profiles. And we keep hearing how there haven't been new discoveries. Discoveries have dropped off the table in the last decade. But my argument is we still have all these other assets that were discovered decades ago that are still around. Companies are slowly working them up, and everybody has their hand out for money, saying, look, this is going to cost hundreds of millions of dollars. Our market cap is nowhere near that price tag. So how are we going to go about funding it? And again, the majors don't seem to be taking those risks to go and build some of these assets. So what's going to change for the developers here, which in all fairness, I feel like there are almost just as many developers as there are explorers now?
No, you're right. But some of these projects have been, like you said, around for a while. And it seems like no matter what the gold price is, they never make any money and nobody wants to build them. So it's almost
the argument is now they should make money. Look at how high the gold price is. Everything should make money. But again, there's so many of them.
Yeah, but argument is made by only changing one component of the valuation, which is the gold price. A lot of them don't change the operating costs or the capital, which have gone up. And so if you look at the study, look at what date it is. If it's pre-COVID, it really does not hold any water. It's going to have to be a post-COVID study. And so, that's what people are looking at. And the other problem is permitting. How long these projects take to permit. So if you're looking in terms of an M&A and you want to make, an accretive acquisition, and you're unsure as to the social license to operate to permit something, you might well prefer something that's already in production with no capital risk. And I can see exactly why these companies are buying operating assets like Newmont. They've been divesting after their, merger with Newcrest, and now they're being able to actively sell assets. Why? Because most of these are operating assets. So, they sold Achim to, I believe, Zijin. They just sold their Colorado asset to SSR Mining, which is trying to diversify themselves out of the hassle they have in Turkey. So there's buyers out there, but they're first going for the producing asset. Then they'll go for the high quality asset, meaning the development asset. But high quality means not only margin, but it also means geopolitically, benign jurisdiction, something with no social license to operate issues, something with access to water, all this sort of stuff, ticking all those boxes. If it doesn't tick those boxes, it's not getting it acquired.
Well, Joe, as we look back at 2024 in Canada and in gold, it was kind of a big year for three big mines getting built. We saw Greenstone get built by Equinox. We saw Cote finally get built and into production from IM Gold. And we saw Magino get built, although it was a messy process by Argonaut, only to be taken over by Alamos that you mentioned earlier in this call. So it's a big year for big Canadian mines, but you made a great point off mic to us that when you look at some of the other mines that are in construction, not just in gold, but when you look at copper, when you look at uranium, and some of the big projects on the table, it's probably going to require foreign investment capital. And there's been some challenges with Canada and foreign investment capital coming in. I'd love you to maybe unpack that a little bit further for some of the deals. And you mentioned Solaris as kind of an area we could look at as far as a workaround to this process.
Yeah, so Solaris has a project in Ecuador. Earlier, I think this year, Zijin Mining was going to put a big investment in them to help them advance their project. The Canadian government slow walked that to the point that Solaris decided to pull themselves out of that process. They did another financing, but they knew, and the end game was with a Chinese suitor. There was no Western suitor that was going to take that project. So to make that happen, then they basically had to re-domicile themselves, change management, and have no employees in Canada. I think they're still TSX listed, so I don't know all the legal impacts from what they're doing, but I'm gathering they paid a lot of lawyers to know what they're doing. And so their whole idea is that they could create an entity that is investable by the Chinese without having to ask the Canadian government for permission. So I would think that other companies that are dealing with especially critical mineral assets with Chinese involvement, where there is no other suitor, they would be looking to probably in the end go down a similar path. And, we've seen other issues with even some gold projects as well, which doesn't make much sense to me in terms of how that works. But yeah, I would definitely be talking to companies that are in these sort of jurisdictions where the Chinese bid is superior to the Western bid, that they would have to look at a path like Solaris in terms of to get to their end game, which might be an acquisition.
Government's getting in the way, hey, Joe. But that's kind of par for the course for the mining sector. How does that tie into then permitting? You've mentioned permitting a couple of times, but boy, oh boy, I felt like this whole year, all companies were talking about was permitting. And quite frankly, it's a slow process, and there's not much companies can say until a permit is released other than, hey, we think we're going to get it. And then on the back end of that, governments, are they going to be more supportive of some sort of mining, even if it is outside of precious metals, more in the critical minerals space? What do you want to take there?
Well, I mean, the S&P Global Market Intelligence came up with this graphic of data about discovery to production. And so they said for copper, it's about 18 years, 16 to 18 years from discovery to production, which seems like a long time. And so that's why I'm so bullish on copper, because if we don't know the project right now, there's no way it's filling any gap in 2027, 2028. So if we go back to that, so I was just in Peru at a conference down there, as well as conducting a couple site visits. I looked at a project called Quellaveco, which is a big copper project that just reached commercial production in 2022, operated by Anglo American. That project was discovered in the 60s, and it was acquired by Anglo American in 1992. So 30 years after it was acquired, it went into commercial production. And that's a project with a big footprint, and it's in Peru. Not all the issues with it taking 30 years were Peru. There's corporate, there's COVID, there's a whole bunch of other things that meshed into that to generate that 30-year timeline. But that's probably more the typical timeline nowadays for these big footprint projects that would make a dent in the market.
Well, Joe, let's dig into copper even further, because I know it's an interest of yours. It's an interest of our listeners. There are some higher profile advanced exploration development projects now emerging in British Columbia, in Arizona in particular, in the United States, and Alaska. Some of them have been stalled for a while. Some of them are making progress. And then there's, of course, all of the South American projects. Do you think that there's enough projects slated to come online in the next couple of years that we really do fill that gap? Is there anything to all of the noise and the chest beating about the supply deficit in copper, and any projects that really have your eyes actually getting to the finish line?
I would say the copper price risk, meaning that, that it might waver or go down, which I don't think about, is on the demand side. So does demand growth grow at 2%, 2.5% compound annual growth rate, or is it like 1 to 1.5%? A lot of that growth was driven by carbon neutral technologies. Does that continue at the same pace, or does it accelerate? So that's, for me, a bigger risk than the supply side. I don't think can fill any gap, just because of everything. We talked about permitting, we talked about water issues, and also capital risk. Because the problem right now is that after Quebrada Blanca 2, how much money Teck spent on building that project and how far wrong they got their own capital estimates. Some of it was COVID, some of it was just building a project in that environment. In the end, it was like an $8.6 billion project, I believe. And this was supposedly brownfields. It's not brownfields because they're completely changing the mine plan, but it's a modification of a permit, which is easier to do in Chile than it is to start a new one. But that's what's scaring a lot of people to build new projects, is they don't think that the price right now of copper is high enough to incentivize them to build. So if, we're talking about, $4, $4.50, but some people are talking about, $5 plus to make people trigger a decision, and so that's why a lot of people are talking about, well, the copper price has got to move because there's no incentive to build anything.
I feel like we've heard that before, Joe, and while that is a valid argument, I don't know how often price actually does follow that, at least in the short term. There's a lot of other factors that obviously play into price outside of what it is to incentivize companies to build. Let's take a little step back now and talk about some recent site visits you were on. A trip down into South America. You were in Argentina and Peru. Look, a lot of the focus in, I guess, south of the border in the U.S. has been in Mexico with the new president. We'll see what changes, if anything changes, with that new administration. But Argentina, boy, oh boy, there's been a lot of positive news coming out of Argentina on the mining front. What's your takeaway from Argentina now that you've just returned from that trip?
Well, Argentina has been positive. So the federal government does not control mining. The provinces control mining. So if the federal government, which has improved and put in incentives for large investments, if that, which it has passed, that's highly positive for the states or the provinces that like mining, which would be Salta, Jujuy, and now the southern part of Mendoza, San Juan, and Santa Cruz, and even Catamarca. So, but those provinces that don't like mining or are anti-mining, that doesn't change anything, because the provinces still control that resource. But what I've seen is the ones that do like mining, their ability to accelerate development in that is good. And so what's happening now in Mendoza is that these guys are coming down and saying, okay, well, we found a place in southern Mendoza called Malargüe, which, Mendoza was always pretty negative on mining since I was there in the 90s. But now what they've done is the government has done the social license to operate in advance for the companies. And so right now they're promoting mining in a certain jurisdiction where they can get away with it, where they have social license to operate, they have access to water. And so when companies come in and raise money, they can do it, no problems. They can go straight in and start drilling, which I think that sort of what they're doing is something other people should look at emulating. So as opposed to forcing the junior company, which is capital constraint and needs to raise money, and they might not be drilling for 2 years because they have to do social license to operate stuff, let the government do that. Let the government tell them where they can go. And then when they do get that, they can go straight in and fund exploration and development. I mean, development meaning drilling, as opposed to waiting for 2 years like some companies have waited in Peru.
Well, it's also been interesting in Argentina to see at the federal level them change those RIGI laws where it helps with export duties by year three. There aren't any, and then also reduces the taxing from 35% down to 25% for companies that qualify the next couple of years with development projects. That's a big boon economically to those companies. But let's talk Peru because you were also just on site visits down in Peru. Peru's been kind of a political roller coaster the last 2 decades, but where are things in the here and now? Is it a good area to be investing in for mining projects?
Well, endowment is why people will take the risk on Peru. There's no denying the endowment of, polymetallic deposits that are world class in Peru. The problem has been infrastructure, which that problem has existed for more than a decade, and there has been no reinvestment in that. Another problem is bureaucracy because of how many governments or presidents they've gone through in the last 8 years. They haven't had somebody go through a full 5-year term since Humala did. So whenever you change a president, you change all the bureaucracy underneath it, and that changes how things get permitted in that and what people are emphasizing. And that's been a huge hassle for juniors trying to drill down there. They're trying to get through that backlog, but in the interim, in the last, like during PDAC, I think they got rid of a mining minister, and then just recently when I was down there, they got rid of another mining minister. So they really need to solidify that position and ensure that people can get their permits. The other problem that they have is that they have an issue with informal mining. And so there's other people that come in there and just start mining. And so these guys are mining without any permits and no surface rights, and they're not paying taxes. And this wasn't a big deal in the 90s when I was there, but over the last couple of decades, it's becoming a bigger thing. When I was down there, they were having a lot of, discussions about that law that they put forward because there was so much illegal mining. Some of it funds criminal activity, but a lot of it doesn't pay taxes. No license to operate sometimes with the local communities. But on the other hand, sometimes the communities on the take and they're getting paid by these illegals. So, for the junior or for the developer or the major company, they're looking at, well, why do I have to run through all these hoops of 2 years just to drill when these guys can just walk in and start mining? So that's something they definitely have to resolve.
Joe, how quickly can countries resolve this kind of stuff? I know Argentina, they go up and down, it seems like every about 5 to 7 years, and they turn right on a dime within a year or two. Peru, though, it seems like we've been dealing with these issues, permitting for quite a while now. Is this a multi-year transition that Peru needs to go through, or could it all turn, let's say, within a year?
Yeah, this current president has the lowest approval rating in the world globally, so less than 5%. And mining could be doing a lot better under this administration, but it's moving forward just because of endowment and, just critical momentum. But I think if they switch in the next presidential elections, we could see a big change. But they would need a lot of foreign direct investment to come in to help them with the infrastructure. And so what you've had recently, while I was down there, or right before, they had the APEC summit. And then with that Asia Pacific summit, the Chinese president was there. And he inaugurated, with the current president of Peru, a new port facility, a multi-billion-dollar port facility 40 or 50 miles north of Peru, Lima. And so that port facility is not only to take goods out of Peru and avoid the, Panama Canal, but also potentially, if the infrastructure is there, to take stuff out of Brazil. And both those countries, their major export destination is China. So we're seeing the Chinese, start coming back and spending a lot more money on exterior investments right now to help their own economy and help their own supply chain.
Well, Joe, while we're down in South America, you brought up Brazil that's had a lot of activity this year. We saw a lot in Guyana, Ecuador, Chile. Any other countries that you really like or countries that you're avoiding in South America?
Well, I'm still not sure about Ecuador, the criminal activity there, and then the power infrastructure there is still a bit of an issue. But I do like Lundin Gold. I mean, they've done very well, and they've got very high margin asset that they keep reinvesting in it. And A problem with a high margin asset in a geopolitically risky area is how do you acquire anything accretive? What they've been doing is reinvesting that in exploration in their own, where they know where they are and what they're doing. And they've been able to grow their asset. And so I think that's worked out very well. So that's a company that's worked well in a geopolitically risky jurisdiction, but also under adverse conditions as well.
All right, Joe, we'll wrap it up here. Again, Joe Mazumdar, editor of Exploration Insights. Joe, it's always so interesting to hear what you're seeing in this market. You've been around for a while, and you always take a very level-headed approach to analyzing individual companies and assessing overall market environment. So, Joe, again, great having you on the weekend show. I hope you have a great rest of your weekend.
Great. Thanks, guys.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
Welcome back. Continuing to listen to the weekend edition of the KE Report. As promised, we are now shifting our focus more to the energy sector, oil and nat gas specifically, as we are chatting with Dan Steffens, president of the Energy Prospectus Group. It's always great having Dan on the show to share his thoughts on where the oil price is going, natural gas price, and a couple companies that he sent us today. We're going to be featuring one multi-billion-dollar company and one of the smaller, more, growth-focused companies in the oil space. If you want to learn more about the Energy Prospectus Group, click the link in the show notes on our website or within your podcast player. Dan, let's start off with oil. Look, oil is choppy, still arguably in a bit of a downtrend, but that $66 level seems to be a pretty solid base over the last really 3 months now, going back to September. However, look, oil can't really seem to get even above $70 a barrel right now. As we're chatting on Wednesday, it's right at that $70 a barrel for crude. Dan, what's going to drive the crude price as it's trading in a tighter pattern here? The big question is it going to break up or break down?
Well, the overall global oil market is much tighter than people think. I believe there's, market forces, whatever you want to call them, a bunch of the, a lot of people investing in stocks, they don't want higher oil prices. They want lower interest rates. So I think there's a bunch of market forces that want to keep oil down because it's the main driver of inflation. If they can keep inflation down, then they feel like they can keep getting more interest rate cuts from the Fed. And I think that's been has oil trapped in this, 67 to 72, 73 range. I'm using $70 in all my fourth quarter forecasts. And I looked the other day, if we ended the quarter today, I'd be slightly above 70 because we started out October and it spiked over 75 for a few days. So the average would be over 70 for the quarter. Now, going forward, I believe the right price for oil is 75 or above, 75 to 85. It may take a while to get there. Now, remember that oil demand is seasonal. So in the first quarter is typically our lowest demand period. And then you get to from the beginning of the second quarter to the end of the second quarter, there's a significant increase in demand for transportation fuels. So that's usually going to be a driver. And that's when I think it'll break out. I mean, I'm looking here at a one-year chart of oil, and you go back to March of last year, we were above 75, and then it ran all the way up to $87 a barrel by the beginning of May. So I don't know if we'll get that high, but I will be, amazed if oil can stay under 75 for the entire year next year. I just think the oil market's tighter and it's not like, there's all this talk of China economy's in trouble. Well, China is still growing a little bit, but India is taking the lead. I mean, India demand for oil was up like 6 or 7% year over year. So, and it's just as big of the population as China. So, as long as human population is growing, as long as the global economy does not go into a major recession, you're going to have, year after year increase in oil demand, so it'll come around. Natural gas, U.S. or North American natural gas prices is a total different story.
Well, Dan, before we get into nat gas, let's just dig in a little bit further on oil as far as the inventories. The EIA report came out, and you were kind of weighing in on that as far as the U.S. inventories, but also counterbalance that with OPEC and what you see coming on the market as far as new supply.
Yeah, I was expecting them to announce an increase in crude oil inventory, but they announced a decrease in crude oil inventory. Now there was increases in gasoline and distillate, but this is a time of year when you're getting, we're heading to a big travel period for the Christmas holidays. At the end of the year, a lot of gasoline is used, so they need to build up gasoline inventories. And of course, diesel is our distillates are used for home heating oil. And now it's a big, as cold wave after cold wave seems to be going across the Northeast down here. We're getting more and more demand for space heating crude oil, our home heating oil. So that's good, and that'll help. And then you kind of have a low demand. Everybody's filled up their tanks for the winter, and that's it. And then you have low demand kind of in January and February. But then you have to start ramping up gasoline production again for the summer months. So anyway, I just think it's tighter than people think. Global observed inventories above ground around the world are at the bottom of the 5-year range. They're not. There's no glut in inventories. There's all this talk of, OPEC's got more supply hitting them up. But then OPEC, the OPEC's now not going to start bringing any more oil back to the market to at least April. And when they do, their plan is to bring it back very slowly. It's not going to be like one day they're going to open up the taps and millions more barrels per day are going to come to market. It's going to be very, very slow. So they're going to manage it. I think OPEC wants oil. I think they want oil like $75 a barrel, and it's Brent's at 73 today when I'm looking at the screen, and I think they want it there or above that price. So I think they can do it if they want to, because they're the only ones with the spare capacity.
Well, let's see where this chart goes, because as I said, it's trading in a tighter and tighter range with the floor being around 66 and change. We'll see. It looks like the chart needs to make a decision here in the next month, maybe. We'll see what that break looks like. Let's move over to natural gas then, because natural gas has been doing quite well. As we're recording this, it's over $3.30. We recently touched that 364 level that was also the high from last year, 2023. Look, it's still way off of any recent highs like 2022 when natural gas ran up to almost $10. What's driving the natural gas price higher here, Dan? Is it simply weather related?
Yeah, it's all weather at this point in time. Now, tomorrow on Thursday, EIA is expected to release a triple-digit draw from storage. I've seen projections for the draw being 165 BCF to 200 BCF. If we have a 200 BCF draw from storage, I think it's really going to push up. And then they're talking about polar vortex coming into Chicago in the next couple of days and all this other stuff. Once you get, sub-zero wind chill factors with a lot of wind through these major cities around the Great Lakes, they consume a lot of natural gas for space heating. I have a sister who lives in Chicago, and I can tell you, when it gets below zero up there, it's really freaking cold. Their furnaces just run nonstop, 24/7. So that's going to do the trick. So we just really need a normal winter. If we have a normal winter, and then we have the LNG export facilities ramp up to their design capacity, which will be about 17 BCF, up from 14 BCF last year. That should take care of the surplus. And then I think you start looking to the back half of 2025, and we're going to need a lot more natural gas-fired power plants to meet the electricity demand for these AI data centers. I'm following one company that's really benefiting from that, Solaris Energy Infrastructure, SEI. I think we talked about it on the last time I was talking to you guys, and man, it just looks better every time I look at it. And they're very bullish on what they're going to be doing in the next year.
Well, Dan, you brought up two big picture themes in nat gas. So beyond the seasonality, beyond the weather, we keep hearing about these LNG terminals, not just in the U.S., but also in Canada. I would wonder, what effect are they actually going to have? Because you would think with all this news coming for the last 2 years that a lot of it would be priced in at this point. A lot of people expected higher LNG, export, the price differential between what we have domestically and what we see overseas to like raise the prices domestically. And with those AI data centers and more nat gas power plants on the docket to replace at least coal-fired plants or actually new plants, why is there not more demand push into these prices? Why don't we see $5, $6, $7 nat gas prices with all these factors?
Well, that's not going to happen until you really drain storage. So until storage goes below the 5-year average, which if we have a normal winter, that could happen in January. Okay, so if we get storage below the 5-year average, then right away I think you start setting a new paradigm that we're going to be short. Now, the one thing to remember too on the LNG exports is during the first quarter of 2024. The big LNG export facility at Freeport, Texas, which was 2 billion cubic feet per day, was offline because they had a fire. And then, they kept having to required all these inspections, everything. They didn't get that thing back online until midsummer, I don't think. So it was down. So we really, even though we had total, including Freeport, about 14 BCF per day of export capacity, we were really only exporting about 12. So once we get Plaquemines is fully up and we get the third train at Cheniere, which is coming on any day now, we should be up to 17 BCF. So you really go from 12 to 17. So that's 5 BCF a day more export capacity per day. So do that over a quarter. So you got 90 times 5. Now you got 450, 500 BCF more demand for U.S. LNG. Now, the thing to remember, I was just talking to one of our members here. He just got back from Europe, and he said they are seriously worried about this winter because they've had a really cold start to the winter in Europe, and European natural gas prices are like $14, $15 per MMBTU. So the profit margin on this LNG is gigantic, and they, with the situation with Russia, they can't count on that gas, so they are heavily, heavily dependent on U.S. LNG imports from U.S. For their gas supply, and that's a big deal. And I think it's going to be a big deal for many years. I don't see any end to that because natural gas is the cheapest form of energy on Earth, and it's also the cleanest for generating electricity. So that's what we need to be using.
Dan, when these LNG terminals come online, then let's just fast forward to that. What types of companies, in your eyes, truly benefit from it?
Well, it's the producers that can get their gas to those LNG facilities along the Gulf Coast. So the biggies are Plaquemines, Louisiana. It is online now. It is online, and it's the biggest of the three. It's over 2 BCF a day, and it's ramping up, filling up right now. There was a little offshore facility, offshore Mexico, a floating export facility, only about a half a BCF. It's been online for about 6 or 8 months. And the third one is the third train at Cheniere that's going to add another BCF and a half. So you add all those together, I think the 3 new ones that are going to be online the first quarter of 2025 that were not online in the first quarter of 2024, it's a 3.3 BCF per day of total export capacity, those 3, and then you add the 2 BCF a day from Freeport, and you're talking about 5 more BCF a day of actual export capacity online in the first quarter, and that's going to make a big difference. So if you have normal winter draws, it doesn't have to be colder than normal, just normal in the eastern half of the United States, the surplus in storage is going to be wiped out. But actually, I was reading this long report from HFI that said that when you look at all the 100 new LNG or NGL power plants that have to be online in the next couple of years, we're going to have a lot more storage because these AI data centers are going to run all year 24/7. So that adds to the amount of gas you're going to need every winter. So our current storage capacity is not enough. We're going to have to build another, like 1 trillion cubic feet of additional storage capacity to balance the market during the high demand periods. So there's a lot of bullish stuff happening for natural gas. I'm very bullish long term. After we get through this next few months and we can get storage back to normal, then I think you're going to see gas firm up. And I'm using 350 for next year. I think the first half of the year will be actually the low point of the year for gas. Will be the first half of the year. I think we're really going to see a bidding war for supply between the utilities and the LNG exporters could set up a bidding war for supply, which is what caused in August of 2022, we saw U.S. natural gas prices go to $9. I don't know if we'll get that, but it's happened 4 times in history. In the last 25 years, we've had gas over $9, and a couple of those times it ramped up to over $13 in the U.S.
Well, Dan, one more just quick question on some of the companies exposed to nat gas. You've made the point before that there's the dry gas component, the methane, but there's also the liquid natural gas. I mean, not liquid, the natural gas
NGLs.
liquids.
Yeah,
Yeah,
NGLs.
NGLs. So when you look at a company that has maybe a healthy balance of the two, what do you think has more opportunity, just the dry gassers or the ones that have the NGLs?
Well, the one thing, if you have dry, like Comstock is pure dry gas. They have no liquids at all. I mean, Haynesville gas is super dry. But the good thing about the Haynesville is its location. It is located in the middle, between Texas and Louisiana, right on the border. Most of it's in Louisiana. But that gas has direct access to the Gulf Coast LNG export. And so does South Texas. One thing, it's not just how much gas, but it's where it is. So, Appalachia, which is home to the Marcellus and the Utica, they're pretty much up against pipeline limitation. Until there's more pipelines built, they can't really increase their production all that much. Haynesville has upside. South Texas has a lot of upside. South Texas, which is home to the Eagle Ford Shale, they have plenty of pipeline access, and they're closer. They're much closer to the Gulf Coast than the Permian. And, there's more pipelines being announced for the Permian, but the big ones are not going to be online until 2026, 2027. So there's no near-term fix for that situation. The thing in the Permian is more and more of these companies are going to be putting in their own natural gas-fired power plants. They have these modular plants that, you need one of them, 2 of them. Think of it as a big Generex generator that's in your oil field, so you can generate your own electricity to run your pumps instead of just giving the gas away. So they're looking at that, but that's not going to be able to get to some of their gas is now going there, but they're not going to be able to increase their gas output from the Permian very much just because of pipeline limitations.
All right. Well, Dan, let's move over to some of the stocks that you sent us, starting with the bigger one, Civitas Resources, traded CIVI. This is a $4.6 billion U.S. market cap. Company has 2 core areas of operation. And let's start with the production forecasts here. Q4 production right around 350,000 BOE a day. That's increasing to around 360,000 BOE a day in 2025. So not a huge growth in terms of production. Where do you see the value in Civitas?
Well, Civitas has grown significantly since 3 years ago. That they were under 100,000 BOE per day in 2022. So they've grown rapidly. Now primarily through a series of acquisitions. They grew their position in the DJ Basin. That's Colorado's DJ Basin. That's a little gassy out there. But then they decided they were going to build a second core area in the Permian Basin, and that's what they've been doing with acquisitions over the last couple of years. So that's gotten them up to 350,000 BOE per day. Now they're about 47% crude oil, 28% natural gas, and 25% high value NGLs. So the NGLs do get a decent price, maybe a third or a half of what the oil price is, but it's still good profit for them. They're an aggressive growth company. They're running 8 rigs today, 6 in the Permian Basin, and the 6 that are in the Permian Basin are in oil-focused areas. So they are trying to push their percentage of crude oil over 50%, and then they have 2 drilling in the DJ Basin. Just without making any further acquisitions, I expect them to increase production about 5% to 10% annually. And the great thing is all of their growth can now be generated, are totally funded by operating cash flow, and they generate a whole bunch of free cash flow. So they're going to generate this year in 2024 about $1.1 billion in free cash flow that's used to pay out dividends, buy back their stock, pay down debt. It's just above what they need for their capital program. And next year, their operating cash flow is going to $3.2 billion. And I'm just guessing that their CapEx program is going to be $2 billion. They haven't officially announced it, but if they keep their if they keep their active rigs running at 8, it ought to be about the same as it was in 2024. So that should still leave about 1.2 billion in free cash flow, again, to pay dividends. Now the stocks pull back. I mentioned them on your show last year, and the stocks really pulled back. Well, I wrote a profile on the company. I was doing some research on it, and I found out from the company that they've had a large insider, a big institutional investor that has been dumping the stock for whatever reason. I don't know. And so because the stock price got below book value, the board of directors decided to just go back to their base dividend of 50 cents a quarter. But they took the money that was going to be paid out as a variable dividend. They're using it to buy back their stock. And for a company this size, now this company has a market cap of 4.6 billion US. They only have 92 million shares outstanding, which is pretty small for a company with this much production and this size and this much growth potential ahead. So if they are aggressively buying back their stock, their per share valuations will continue to go up. They don't because they're generating so much free cash flow. They really have no near-term debt problems. There's nothing that I can see that justifies the stock price pulling back. I mean, it's down like 30% or something year to date, and I think it'll bounce back because they've said that this seller is pretty much done now. So there's no big seller dumping hundreds of thousands of shares all the time. And if they start buying back the shares themselves, that should set a floor under it. Now, my valuation, so it was trading today at 47.25, open on Wednesday at 47.25. And based on the current payout for 2024, the dividend yield is 10.5%. So it's a really nice dividend stock anyway. And if they start buying back their stock, it should start pushing the share price up. I think the timing when they announced that they were going to just pull back to the base dividend, it was during this period of, just a couple months ago when the market was in this, bearish attitude of where oil prices are going, where the gas price was still low. And I think in people that had invested in this company and in the stock for dividends, as soon as they cut the dividend, yield investors are very antsy about a company that, even if they have a very good reason for cutting the dividend, they all hit the sell button and, it causes sell off. So I think that selling's over. I think they are going to announce a really good fourth quarter, and it does produce a lot of gas. So it's going to get a big revenue boost from increasing gas prices. So anyway, it's, I sent you that one slide that shows that it's got a free cash flow yield of 21%. I mean, that's way at the top of their peer group. It's just crazy where the stock's trading right now.
Well, Dan, I'm glad you brought that up. That's exactly where I was going to go, is if they have the second highest free cash flow yield within their peer group, 21%, that's amazing. And they have been buying back their shares, to your point. But when you look at their valuation compared to the peer group, they're just not there when you look at, their enterprise value based on their EBITDA, different multiples. And you brought in some slides and some of the research you presented to your subscribers talking about the recent selling that you've already mentioned. But what else is behind this mismatch between their free cash flow yields and then where they're valued compared to their peers?
Yeah, I mean, it's a little bit gassy. And up until just recently, there's been, this feeling in the market that gas was not good. Well, I think that's flipping. And in fact, I saw like 3, analyst reports today that are really telling people to switch their portfolios to more gas producers. So if that trend, on Wall Street gets going and, hedge funds, they're going to be looking for company. Now, Civitas, I mean, for its size, it's pretty much off the radar screen. And I think that's because it's based in Denver. Its largest core area is the DJ Basin in Colorado. That the DJ does not get the coverage it should. It's not considered to be like another Permian Basin or anything. And there's also a perception that there's political risk in Denver or in Colorado because the Democrats control Colorado. But the state of Colorado gets a lot of revenues from the oil and gas business, and their governor, I've been to things where he's made presentations out there, and he's very pro oil and gas because of what it does for their state. But anyway, I think this is one of those things, if people start looking for valuation, they're going to see this thing go, wait a minute, I had one of our members, in reaction to our published report we put out the other day, he calls me today and says, I don't get this. Why in the world is this thing trading so low? And I said, well, obviously the Wall Street gang, it kind of agrees with me because first call's price target is like $75. And there's the four most recent analyst price target updates on it have all been way above the current share price. I think the highest one was $83 or $84 share price target on it, which is almost, double where it's trading now. So anyway, I think there's just a lot of upside in one. And again, pays nice dividends while you're waiting.
Well, and that's the thing. This is a head scratcher. It pays big dividends. Just the forecast that you have in terms of operating cash flow, $3.2 billion. That's closing in just on the company's market cap, let alone the $1.2 billion of free cash flow. That's what, a 4 multiple, not even a 4 multiple to the market cap. So is there something else here? Is there large capex coming? Is there a lot of spending that the company has to do? Is there a lot of debt on the books? Even though you said debt wasn't an issue, is there some sort of a red flag in either of those categories?
Yeah, but there's nothing to justify the stock trading below book value. Think about it. It's extremely profitable. Its reported earnings are going to be like, what, $6 or $7 a share this year. Reported earnings, GAAP reported earnings, are going to be $8.50 a share. So this thing's trading at a PE ratio less than 5. And all growth is funded by operating cash flow, and it's generating $1.2 billion in free cash flow, which can be used to pay off debt, buy back stock, pay great dividends, which they're doing. I don't get it. I mean, there's no justification for this company trading below book value, which this is what, value investors look for. So then you have to ask yourself, okay, they produce oil and gas. Is for some reason where this world's not going to need oil and gas in the near term? No. So, I mean, I don't get it. But this is the kind of thing I'm looking for, and this is the kind of company, exactly the kind of company I like to present to our subscribers, because that's my job. My job is to find undervalued companies and tell them about it.
Well, Dan, it does look very undervalued, that's for sure. We'll keep following along with it, and it's definitely a story that I think should be on more people's radars. I rarely hear it discussed, to your point, but let's dive into another company that you did bring to our attention, which we've had on the show a number of times, and that's Hemisphere Energy, traded on the TSXV under the ticker HME, and on the OTCQX under the ticker HMENF. Now, this is a company that is operating in Canada. The Atlee-Buffalo area in Alberta has been their bread and butter. They've been doing water floods and then polymer floods. And then more recently, they've tacked on the Marsden project in Saskatchewan, where that's really their growth profile and their growth platform moving forward. Walk us through why you think this stock is also undervalued, Hemisphere Energy.
Okay, first of all, Don Simmons, the president and CEO of the company, he spoke at our Houston luncheon on Monday, December the 9th. So we got good, fresh information from him. A lot of our members, we had about 40 people at the luncheon. I would say 75% of them have a large stake in Hemisphere. We've been following the company almost since Don became the CEO. I met with him in Calgary, and I was very impressed. Just a straight up great guy. I have great confidence in his team. He had come to Houston. His original funding to develop Atlee-Buffalo was a private equity company based in Houston. He has since then paid off 100% of that debt. 100% of their investment has been returned. They got a bunch of warrants on the company for funding it. So they are their largest shareholder, and they have no interest in selling. So that's good. And current production, it keeps ramping up. Its current production is about 3,750 barrels per day because it's almost 100% oil. They use the little bit of natural gas they do produce. They use that to generate electricity in Atlee-Buffalo. They run all their pumps off of their own natural gas generators. And so they're really in good shape there, which does keep their cash expenses very low. The one thing he pointed out is they're all cash expenses, which includes operating expenses, production taxes, even their G&A and their interest expense, which they now have no interest expense. They have no interest-bearing debt. So it is a pristine balance sheet, which is why I like it. And even, if Marsden doesn't work out, and I think it will work out, but if it doesn't, they're still going to generate about 10% production growth next year. They have about 10 or 12 more wells to drill and complete at Atlee Buffalo, and then that'll be drilled out. So they need something else. And during Q&A after the luncheon, he was asked, well, are you looking at other deals? I mean, you got all this free cash flow. Why don't you go buy something? Why don't you get some production going? And he goes, we're looking at stuff all the time. But we're not going to spend something that doesn't look good to us and is in our area. They're not looking in the U.S. or anything. They're looking in Alberta, the areas that they know quite well. And so anyway, but it is generating a lot of free cash flow. Like we were talking before, this year their operating cash flow is going to be about 55 million Canadian. Their capital program is only 21 million Canadian. So they're generating this year, 2024, 34 million in free cash flow, which now that they've paid off all their debt, they're just going to keep, if they don't buy something, they're going to keep distributing that as dividends. They have quarterly dividends of 2.5 cents per share, but they pay 2 special dividends of 3 cents per share. So if you add that all up, they paid out in 2024 16 cents, which is a dividend yield of about 8.7% dividend yield Canadian. Now, if you're a U.S. shareholder, they withhold 15% on those dividends, but you do get that back as a foreign tax credit on your tax return. So anyway, but the Marsden field, so, he gave us an update on that. They have completed 5 wells in Marsden. They're all horizontal wells, 5 horizontal wells. So let's say 1, 2, 3, 4, 5. The number 2 and number 4 wells between the others are injector wells. They are already injecting water that has been, upgraded with the polymer flood, and those 3 producers. So they have not reported any production there yet, but they should report a little bit of production there in the fourth quarter. And then it'll take them probably till mid-2025 before they're 100% sure the polymer is going to work. And so it could become a big part of their capital program in the second half of next year. But it's not going to be significant production from Marsden until you get to like 2026. But they're still going to increase production next year, I think about 15 to 18% just at Atlee Buffalo.
So when are we going to find out? What are some of the timelines around assessing what's happening at Marsden, how successful these floods are?
Yeah, he said they should know something about 6 months. The first thing you start seeing is downhole pressure increase, and then you get higher fluid production coming from the 3 producers. And but this is a big area. I mean, it's 13 or 14 sections of land. So this little pilot program is just one small area. I mean, there may be room for 100 horizontal wells there. So it's a big development potential. And when I went talking to him before on the phone and stuff, he's told me that we're talking about, if it's successful, if it's what they think it's going to be, could double Hemisphere's production in a couple years and maybe triple it in 5 years or something. They're going to go. The one thing about Don is he's very conservative. He's going to go slowly. He's not going to go crazy, drill baby drill until they know stuff's going to work. And he wants to keep the company free cash flow positive, and he wants to keep paying these big dividends year after year. I think the wives of the management team really like that.
Yeah, I think everybody likes the big dividends year after year. But let me ask you this. I mean, he was very successful. Their team has been very successful in the Atlee Buffalo with both the initial water floods and then the polymer floods, and they brought on a lot of wells. But talk to us a little bit more. You mentioned how big the land package is at Marsden. So talk about, the growth profile. Let's assume that it does work. Like with that caveat out of the way, if it works, how big is Marsden as far as, you said there's room for 100 wells, but what could they realistically do in 2026, 2027? Give us a sense of the growth the company could go through if this thesis plays out.
I think if it works, I mean, across the entire acreage block, you're talking about a tripling of their potential production. But the one thing he also said, and I didn't know, there's like 2 other zones besides the one they're flooding that are potentially have oil in them. So which have been produced with vertical wells. So they know there's a significant amount of oil in place. So what they're just trying to do with the polymer flood is make that from oil in place to recoverable oil. And once they start getting credit for that in their year-end reserve report, that's what's going to drive the share price higher. And the thing is, companies, especially the ones with, pristine balance sheets, they don't trade below the value of their proven reserves for long before somebody walks in and makes a big, offer for the stock or something. Because, there's people looking for stuff like this, and especially when it's already free cash flow positive. And the thing about polymer floods is they have very low decline rates. Like, he's got low single-digit decline rates in that field. And actually, he showed us charts of how the wells have been doing at Atlee Buffalo. The original, 42 wells that they had drilled before they started polymer floods there, they've actually increased it. They haven't had a decline in production. They've increased production significantly above what their primary production was. So the polymer flood is definitely working. That's proof that it's working at Atlee Buffalo. And when I was at Hess, we had several very successful tertiary recovery projects, especially in the Permian Basin. We had the #1 CO2 flood in the world in the Seminole San Andreas unit. And that unit went from 12,000 barrels a day. It was a big property, but 12,000 barrels a day to 64,000 barrels a day. And it stayed at 64,000 barrels a day for 8 years before it went on decline. And he was saying at the luncheon, he says they're expecting Atlee Buffalo to plateau, maybe in 2 or 3 years, but then to stay at that plateau for several years. So that's what I really like about this. This is not like some shale, wells that come on strong and decline rapidly. It's not anything like that. This is a strong asset that should provide, it's generating over $50 million of operating cash flow right now.
Yeah, nothing wrong with that. Hey, Dan,
No
nice
kidding.
cash flow numbers, and as you said, that pristine balance sheet, no debt.
And real low G&A. Real low G&A. He has a fairly small staff, so it isn't like this company has all this, salaries going out the door or anything. It's a very cash flow machine.
Hey, look at how well the share price has done too. Entering 2021, the share price was a penny stock practically. It was around 10 cents a share. Now it's right back to, it recently touched $2 a share just a couple months ago. So a couple opportunities there that Dan Steffens has shared with us. Again, Civitas Resources and Hemisphere Energy. And Dan, great chatting with you. Again, if you want to follow along with Dan and the Energy Perspectives group, click that link in the show notes. Dan, it's great having you on the show. And everybody, thanks for tuning in to this weekend show. Be sure to go back to our website, kereport.com, and podcast. Just search the KE Report in your podcast player to follow along with all our daily editorials, company updates, and, of course, extended versions of this weekend show. Everyone, thanks for tuning in. I hope you all have a great rest of your weekend.
The Corlin Economics Report is produced for A.B. Corlin and Associates. Opinions expressed on this program are intended solely for the entertainment of our listeners, do not constitute investment advice, and are not necessarily those of this network, radio station, or our sponsors. Find out more about this program and today's guests by visiting www.kereport.com. For Al Corlin, this is Colleen Robbins. Join us again next week for the Corlin Economics Report.